Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 26th September 2025, and joining Lee to pose some questions on the financial market themes for the week ahead is Seiko Kataoka-Fisher, Director from Japanese Customer Sales for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Seiko.
US dollar has continued to rebound over the past week following last week's FOMC meeting. What have been the encouraging stronger US dollar this week?
Yeah, like you said, we've seen the dollar continue to strengthen on the back of last week's FOMC meeting. The dollar index now is up almost 2.5% from the low point from late last week. So clearly the dollar is regaining some upward momentum going into next week. And we do think that upward momentum over the past week has been supported by some evidence of resilience for the US economy. We did see a big upward revision to US growth in the second quarter. And if we look at what was one of the main drivers for that upward revision, it was the consumption part of the economy, particularly the service sector consumption, which, as you'd expect, should be less impacted by the tariffs that have been put in place. So it does kind of make sense from that perspective. And while the bigger picture still is that consumption growth and economic growth in the US did slow down in the first half of this year, I guess the fears over a kind of sharper slowdown have eased on the back of the upward revision to consumption growth in Q2. We're also kind of highlighting as well, if you look at the breakdown of growth in the first half of this year, you'll also see as well that the tech sector, investment in the tech sector has become a bigger driver for growth in the US, particularly if you look at investment in computing equipment and software. That's added almost up to 1 percentage point to growth in both Q1 and in Q2. And if it hadn't been for that investment in the tech sector, then growth overall in the US economy would have been kind of closer to stall speed in the first half of this year. So that's certainly an encouraging development for the US economy, that this pickup in investment in the tech sector is helping to offset the drag and disruption to growth from the tariff policies and heightened policy uncertainty we've seen from the Trump administration. So yeah, I think for the market, that's making the market more wary about continuing to price in such aggressive Fed rate cuts going forward. Like, we still think the Fed will do another 2 cuts by the end of this year, but you say the risk of them doing less now is higher. But I think for them to kind of pull back and not follow through on delivering those 2 cuts, we'd also need to see some evidence as well of a pickup in employment growth.
What will you be watching out for in the week ahead?
Yeah, like I said, I think next week is going to be important. Like I said before, we have seen this divergence opening up between US economic growth. Like you saw in the second quarter, growth came in at 3.8% annualized, which is strong. Obviously, that's after very weak growth in Q1. But that pace of growth was certainly not consistent with the employment growth that we saw in the second quarter, where if we look at average employment growth per month in Q2, that slowed to about 50,000 per month. So we have seen since that weaker pace of employment growth did continue in the following couple of months in Q3. So this divergence has clearly opened up now between kind of weaker US employment growth, whereas the economic growth is somewhat stronger. Obviously, that's going to resolve itself in a number of ways potentially going forward. So obviously the market's going to be watching even more closely the payrolls report released at the end of next week to see if we start to see some signs potentially of employment growth picking up as well. Obviously, that would be the best case scenario for the dollar, would make the US rate market even less convinced that the Fed will cut rates again as soon as the next meeting in October. Having said that, though, we could see this divergence between labour market weakness and employment growth continuing. Obviously, if employment growth continues to remain weak next week, somewhere around 50,000 or around that area, then I think the Fed would continue to kind of prioritise those downside risks to the labour market and would then have the grounds to continue with their plans to keep cutting rates through the rest of this year. So in that kind of scenario, could see the dollar kind of easily giving back the gains that we've seen over the last week or so. The other thing that we'll be watching next week as well on the economic data front is the release of the latest Tankan survey from Japan. The BOJ have kind of indicated that they'll be looking at that closely to try and further assess the impact on Japan's economies from the tariff hikes that were put in place by the US on exports from Japan. If that continues to show that the Japan's economy is proving relatively resilient to the tariff hikes, then we do believe that the BOJ still could be in the position to resume rate hikes at their next policy meeting at the end of October. I think by that point in time as well, I think the political uncertainty in Japan will likely have cleared. So it would certainly create room there more for the BOJ to resume rate hikes as long as there's no kind of big kind of downside surprise in next week's Tankan survey.
Thank you very much, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Please rate, review, and subscribe to our podcast. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.